Hello and welcome to this month's Market Matters video update. My name's James Gerish. On Thursday, the 11th of July, you'll notice that I'm not joined by Harrison Watt today. Harrison Watt has left to go overseas for a couple of years and get some experience in the UK in terms of funds management. So after 8 years on the desk with me, Harry has gone to expand his horizons, and we wish him all the very best. Harry remains a shareholder in our business. And I hope that Harry will be back at some point in the not too distant future. In the next month or so, I'll be introducing you to Harry's replacement, a really well experienced, well credentialed individual who will be taking over from Harry's role. So in the coming months, I'll introduce you to that person, and no doubt you'll get to know them over the coming years as subscribers, members to Market Matters. So in today's update, I want to give you a quick overview of how our portfolios performed in FY24. It was a really interesting but positive year in terms of markets. We had some outperformance across some of our portfolios. We had some underperformance across others. We had a tougher June, to be honest. So we had a positioning around portfolios going into June that gave back some of that recent outperformance in that month. So a little bit of a frustrating end, but I'll give you all of those numbers across the suite of Market Matters portfolios in the next couple of minutes. So in terms of the active growth portfolio, this is a large cap ASX top 200 strategy designed to actively manage a portfolio for outperformance over a 3-year period. So in FY24, the portfolio was up 14.3%. It was 2.2% above the benchmark's return. The ASX 200 delivered 12.1% inclusive of dividends. If I sit back and think about this portfolio longer term, it's been in operation since 2016, and it's delivered a bit over 14% per annum in that time frame, which is about 5% above its benchmark. So very happy with how the portfolio has progressed over longer periods. We went into May June at the back end of May with outperformance of about 5%, which is in line with our longer term averages. And then May came along and we dipped 1.6% from a portfolio perspective, which was about 2.6% below the benchmark. So the reason for that was our overweight positioning in commodities. It served us well in FY24 to date, but it didn't serve us well in June. We've maintained the majority of those exposures in the portfolio, and we think there's a combination of things that will support the commodities trade from here. It's not working yet. But we think there is a number of factors that will support the commodities trade in FY25, predicated on the expectation around monetary policy over in the US. So interest rate cuts over there. We think the US dollar is susceptible to weakness, and that should be supportive of commodities. Not all commodities have followed that negative path. So gold has been particularly strong. Copper had been strong for much of FY24, but gave back some of those stellar gains in June, and that weighed on our portfolio. So we'll remain active around our exposures in that portfolio as always, and we've had a strong start to FY25. The portfolio's up about 2%, 2.5% for the month so far. Moving on to our active income portfolio, which is a little bit more conservative in nature. It holds large cap, high yielding Australian equities combined with real estate investment trusts and ASX listed hybrids and other income securities. So a bit more defensive, bit more consistency, lower volatility, lower drawdowns, and that portfolio delivered 7.15% in FY24, about 1% below its RBA cash plus 4% benchmark. On longer time periods, it's up 8.1% since inception. It's been in place since 2017, which is about 2.8% per annum above its benchmark. And in the month of June, it was actually the only portfolio that outperformed in that period. It was up 2.01%, well and truly above its benchmark, and above what the ASX 200 delivered in that time frame. In terms of the last of our domestic focus portfolios is our emerging companies portfolio. This was launched in 2020, so a shorter time period in terms of performance history. That was up 12.87% for the past 12 months, so to June 30, 2024. That was about 3.5% above its benchmark, and that was even given what played out in the month of June, where the portfolio gave back 4.09%. Versus the Small Ords, which were down 1.4. So it's a portfolio focused on growth outside the ASX, outside the ASX 100, I should say. So that it's going to be a choppier portfolio in nature, but we're really starting to get some runs on the board in terms of the performance on the emerging companies portfolio. And if small caps had a really difficult year still in FY24. I know the index was up 9.35%. But that compares to the ASX 200, which was up 12.1%. And obviously, international markets did a lot better than that. Small caps have remained a tough place to invest. But if we get this support, monetary policy support, interest rate cuts over in the US, the broadening of the rally that's starting to play out over in the US, and we'll touch on this very shortly, then I think small caps will start to show some outperformance relative to large caps. In terms of our international equities portfolio, which is a portfolio that we have been running since 2019, I'll just find the performance stats for you. We launched this in midway through 2019. It's done 17.2% per annum since inception, which is about 4% above its benchmark. The benchmark is the MSCI World Index in Aussie dollar terms. In the last 12 months, it did 15.68%. It was below its benchmark by about 4%. The reason for that is the composition of the portfolio doesn't have as a higher weighting the Magnificent Seven as the benchmark does. We still own Apple and we still own Microsoft, and they've been phenomenal performers for us. But simply index weight versus our portfolio weights are not aligned in terms of the Magnificent Seven. In the month of June, we fell 3.75% against a benchmark return of 1.61%. So it was a tough end to FY24, and I think that's true across the majority of our portfolios. So having a really stellar 11 months of FY24 and giving back some of that outperformance in the June month was frustrating, but that's markets. You've just got to you've got to continue on and look forward, as opposed to sulking, as perhaps some of us do when underperformance comes in at the wrong end of the year. So in terms of the international equities portfolio, as I touched on, we think it's going to be really interesting. We're going into US quarterly earnings season next week. We've had I think it's really pointing towards a couple of interest rate cuts over in the US before Christmas. So Jerome Powell's delivering a couple of testimonies this week that implied as much. The market is certainly positioned for that. We go into second quarter earnings season expecting the earnings recovery, or the improvement in earnings to broaden. So obviously the Magnificent Seven is going to print some really impressive earnings growth numbers, but for the first quarter in the last 5, we're expecting the rest of the market to actually grow earnings by about 5%. So that would be supportive of the broader US market and be supportive of the Market Matters international equities portfolio. And then rounding out the 5 portfolios, we recently introduced a core ETF portfolio designed to be a more of a passive core aspect for members that they could utilize, less active, more diversified in terms of asset allocation. It holds all the major asset classes to varying degrees. We do dynamically change our asset allocations, although we haven't been needed to in the past 12 months. And that portfolio delivered 10.3% for FY24, about 3% above its benchmark. Since inception, it is only about 15 months old. It delivered 8.2% versus benchmark of 7.19%. So that speaks to a really well diversified portfolio using low cost ETFs that require less active management than perhaps the other Market Matters portfolios. And in the month of June, it put on 70 basis points, which was about 10 basis points above where its benchmark was. So if we cap out FY24, it was a positive year, no doubt, for markets. So ASX 200 was up over 12%. The US market was up a lot stronger, but the composition of the US market was a little bit different than what those headline numbers would imply. So small caps were a lot lower than what the headline numbers for the large cap indices over in the US, and then more industrially focused indices also underperformed the S&P 500 and the NASDAQ. I think looking forward, the main aspect we'll be focusing on is, earnings. So we're going into quarterly earnings over in the US, and then August brings the full year reporting season here in Australia. So that's going to be really key for where the market goes from here. Obviously, monetary policy in the US, I think the path is now fairly well ingrained. There's a few more question marks in terms of monetary policy here in Australia. Will the RBA hike again? Will they just sit on hold? And when can we expect cuts in FY25 if we get them? So there's a huge divergence in views out there in terms of what markets are expecting. We don't think they'll hike rates. We think they'll sit on hold, and that ultimately will be supportive for the ASX, and particularly some sectors within the ASX. So we'll continue to write about those. We'll continue to actively manage our portfolios as we have done now for over 10 years at Market Matters. Thanks for watching, and I'll be in touch in the next month.